So, stay away from bonds or dive in. Jack Malvey, Chief Global Fixed Income Strategist, Lehman Brothers. Art Steinmetz, manager of the 5-star rated Oppenheimer International Bond Fund. Start with Art. What do you think? Should we buy or sell?
Well, I'll talk my book here. It's a simple maxim. Buy bonds where interest rates are high and going down, sell them where they're low and going up. The United States would be one of those countries where they're low and going up, but there are places outside the U.S. where they're high and coming down.
Such as?
Brazil, still a top pick. Inflation in Brazil is running at about 3.5%, which is certainly higher than it is in the U.S., but not by much. But interest rates there are still over 10%.
Okay. Jack, what do you think?
A little bit of a buy, at least for U.S. investors over the near term. Rates are higher than they were at the beginning of this year. There is near-term risk to higher side, but we're still in the range that we've been in over the course of the last 3 years.
Anything keeping you up at night about risk here?
Well, we're undergoing a repricing of risk in the credit markets, to be sure. We've been priced to perfection. We're moving to price to reality. Certainly this has some momentum, and it's not over, and probably will finish sometime sort of the middle of the third quarter.
Jack, in your notes, you say the second half of the year should actually be better for bonds than the first half. Why do you say that?
We had sort of a miserable first half for world bond market returns. Collectively, investors only had about 0.5% return, with European central banks and also hopefully Asian central banks finishing or getting close to the termination of their tightening policy. World bond market returns should begin to improve. The starting line, though, is probably sometime maybe September, October, as opposed to instantly here in July 2007.
Okay. Art, you say Brazil is the best opportunity?
The single best opportunity. The problem we face is, you have this coordinated rise in global interest rates, as Jack pointed out. The ECB told us today to watch out because they're probably going to be hiking rates some more, even though they didn't today. The Bank of England did hike rates. The U.S. used to be a high-yielding country, but rates everywhere are going up, and most interestingly, converging with the U.S. from below. So the U.S. is certainly one of the safest markets in the world, but is no longer the only game in town when it comes to places where you can find high interest rates. And again, the United Kingdom, higher rates than the U.S., obviously a pretty safe place to invest. So the U.S. has got a lot of competition out there.
If I assume there are bond funds out there that I can buy that will get me in there?
Into international bonds?
Yeah.
Certainly there are many, including ours.
All right. If I'm uncomfortable with some people are uncomfortable with the idea of investing outside their home country.
Well, I think it's kind of a lifestyle hedge. Consider not so much just the risks in your portfolio, but consider the risks of also on the expense side of your balance sheet. A lot of the stuff you buy is made outside the United States. That's an obvious statement. But consider what happens if the U.S. dollar then becomes a much weaker currency. Well, the price of sneakers at Walmart is going to go up. If you have some assets in your portfolio that are going to rise in value because of the weak dollar, that's probably a nice piece of investment to have in your portfolio. That's why we think everybody should have some investments denominated in currencies other than the U.S. dollar.
All right,
so
Jack.
It might be the safe, conservative thing to do.
All right, Jack and Art, thank you very much. Jack Malvey, Lehman Brothers, Art Steinmetz, Oppenheimer.